Hello, everyone. Did you read the article Cracks Beneath the Surface? What the U.S. job market is really telling us? At first glance, the U.S. job market looks strong, with steady unemployment and over 130,000 new jobs in May. But when we look deeper, we find signs of stagnation and risk. Most job growth is in a few sectors like healthcare and hospitality, and economists warn this concentration is dangerous. Government policy shifts, falling demand, and consumer pessimism are also raising red flags. Let's unpack this complex picture with a short quiz to sharpen our understanding. Let's take a closer look at today's story by checking your understanding with a short quiz. You can pause if you need more time to think. Ready? Let's get started. First question, what concern do economists express about the current U.S. job growth? A, it's increasing too quickly across all sectors. B, it's concentrated in too few industries. C, it's driven mostly by student employment. D, it's focused on rural manufacturing. Take a moment to think about it. The correct answer is B. The article explains that most job gains are coming from healthcare and hospitality, and economists worry that this narrow concentration could pose economic risks. Number 2, which of the following factors is not mentioned as a warning sign in the job market? A, government policy changes. B, high levels of consumer confidence. C, declining demand. D, concentrated job growth. Consider your answer carefully. The correct answer is B. The article highlights pessimistic consumer sentiment, not confidence, as a warning sign. It does not mention high consumer confidence as a factor. Time for a quick true-false quiz. Number 3. Over 130,000 new jobs were added in May, mostly in manufacturing and finance. Think about your response. The answer is false. The article says that job growth was mostly in healthcare and hospitality, not in manufacturing and finance. Number 4. Some economists warn that weak job creation outside of a few key sectors could signal a fragile economy. Reflect on your answer. The answer is true. The article states that reliance on only a few industries for job creation is risky and could mask underlying economic weakness. Having explored the article through these questions, let's now engage in a discussion to delve deeper into the themes presented. Consider the following question and share your thoughts. Here is a question for you. What are the long-term risks of focusing economic growth in only a few sectors? That's a really important question, especially when job growth is coming mostly from just healthcare and hospitality. What do you think happens when an economy relies too heavily on just a few sectors?
Well, the first issue is vulnerability. If one of those industries slows down or faces disruption, like we saw with travel during the pandemic, the whole economy can suffer. In the UK, we've faced this with over-reliance on finance in London. When that sector struggles, the regional economies don't have enough support. Diversification gives resilience. Without it, recovery becomes much harder. Over-reliance on a few sectors increases economic fragility. It creates uneven regional growth and inequality. When disruption hits, recovery takes longer and costs more. A diverse economy is more adaptable to change.
Thanks for joining today's session. As we saw, job numbers alone can be misleading if growth is limited to a narrow slice of the economy. True resilience comes from diversity, across sectors, regions, and types of work. Let's keep asking, are we building economies that can bend without breaking? See you next time.